Assalamualaikum, my name is Siti Nur Alia Balkis Mitra Milis and my metric number is BEETK302322. So today I'll be presenting the answers for quiz 3. When we look at the mechanics of the foreign exchange market, a leftward shift or a structural decrease in the supply of the Malaysian ringgit happens because Malaysians are selling less RM to purchase foreign currencies. This behavior is completely driven by a drop in domestic demand for foreign goods, services, or assets. First, a decrease in Malaysian demand for foreign import, which can happen if local consumers prefer local products or if domestic incomes fall, means fewer ringgits are supplied to buy foreign currencies. This shifts the supply curve left, causing the RM to appreciate and directly benefiting local importers and outbound tourists. Second, an increase in Malaysian interest rate relative to foreign rates. For instance, when Bank Negara Malaysia raises the OPR, makes investing domestically far more attractive. Local investors will keep their funds right here at home rather than converting RM to invest abroad, which reduces the RM supply, appreciates the currency, and benefits domestic savers, local investors, and anyone holding RM assets. Finally, lower inflation in Malaysia relative to trading partners makes foreign goods look relatively expensive. This discourages import, meaning Malaysians supply less RM to buy foreign currencies, which again leads to an appreciation of the ringgit, ultimately benefiting local consumers through stable domestic prices and stronger purchasing power abroad. To determine the purchasing power parity implied exchange rate using the famous Big Mac index, we look at the price ratio between the two nations by dividing the local price of a Big Mac in Malaysia, which is 50 ringgit, by its price in the United States, which is USD 5.5. We get a theoretical PPP implied rate of approximately 2.73 ringgit per USD. Now, to evaluate the actual valuation of the ringgit, we compare this theoretical rate to the actual market rate of 4.2 ringgit per USD. Because the actual market rate is higher than our PPP implied rate, it means you actually need more ringgits to buy a single dollar in the real market that you theoretically should, which proves the RM is undervalued. To find the exact percentage misaligned, we subtract the market rate from the PPP rate and divide the result by the market rate, which reveals that the RM is undervalued by approximately 35%. Under absolute purchasing power parity, the exchange rate is simply determined by the ratio of the cost of a basket of goods between two countries, dividing the Malaysian basket cost of 5,500 ringgit by the US basket cost of USD 1,250 gives a PPP implied rate today of exactly 4.4 ringgit per USD. Because this matches the actual spot rate perfectly, it indicates that the market is currently in absolute PPP equilibrium. Moving to relative PPP to project the expected exchange rate after 2 years, we must factor in differences in annual inflation over time, where Malaysia's inflation sits at 2.5% and the US sits at 3.8%. By compounding this inflation ratio over a 2-year horizon and multiplying it by our initial spot rate of 4.4, the expected future exchange rate drops to 4.29 ringgit per USD, showing that the RM is expected to strengthen due to Malaysia's lower inflation. Finally, if the actual market rate is 2 years turns out to be 4.30 per USD, comparing it to our expected rate of RM 4.29 shows that because the actual rate is slightly higher, it takes slightly more RM to buy a dollar than inflation differences predict, meaning the RM is marginally undervalued against the USD. Moving on to the forward currency market, it is essential to distinguish between the long and a short position. A long position represents a binding contractual agreement to buy a foreign currency at a specified forward rate on the future date. This position is typically taken by importers who must pay foreign suppliers or borrowers who need to repay foreign currency-denominated loans, effectively hedging against the risk of foreign currency appreciation or the RM depreciating. A clear Malaysian example is Proton, which might take a long position in the USD to lock in its ringgit's cost when importing high-tech car components invoiced in US dollar. On the flip side, a short position means a contractual agreement to sell a foreign currency and receive local currency at a specified forward rate in the future. This is typically utilized by the exporters, receiving foreign revenues, hedging against foreign currency depreciation or RM appreciation. Prominent Malaysian examples include Top Global or Sime Darby Plantation, which take short position in USD to guarantee their export proceeds when billing international clients. Given the current spot rate of 4.15 ringgits per USD and the 3 months forward rate of 4.09 ringgits, we can easily see that the USD is trading at a forward discount. This is because the forward rate is cheaper than the spot rate, indicating that the market expects the USD to weaken against the RM over the next 3 months. To calculate the annualized forward premium or discount relative to the spot rate, we take the forward rate of 4.09 minus the spot rate of 4.15, divide by the spot rate of 4.15, and then multiply by 12 over 3 months and multiply by 100. This standard calculation yields a result of approximately negative 5.78%, confirming that the USD is trading at an annualized forward discount of 5.78% against the RM. Since Sime Darby is an exporter due to receive USD 1.2 million from an overseas buyer in 3 months, they face the risk that the USD might crash, so they should take a short position to contractually lock in their conversion rate. Under this forward contract, the guaranteed revenue is calculated by multiplying the 1.2 million USD by the forward rate of 4.09, which equals exactly 4,908,000 ringgits. If they had chosen to gamble and leave their position unhedged, they would have been forced to sell at the actual open market spot rate of 4.25 ringgits per USD 3 months later, yielding a revenue of 5.1 million ringgits. Comparing the two outcomes, hedging resulted in an opportunity loss of 192,000 ringgits because the USD unexpectedly appreciated in the open market. However, from the risk management standpoint, the hedge was completely successful. The primary goal of a forward contract is to eliminate uncertainty rather than speculate, and by locking it in the rate, Sime Darby guaranteed a minimum revenue of 4,908,000 ringgits 3 months in advance, protecting their business from potential downward market crashes. The traditional approach contains 4 major limitations that motivated the asset market models, as it focuses too heavily on the trade balance and treats the capital account as a passive residual. First, it neglects that capital and financial account dynamics, ignoring the fact that the modern global capital flow dwarfs trade volumes. This is seen in late 2024 and early 2025 when massive foreign investment into Malaysian data centers and semiconductor plants threatened the ringgit before any goods were exported. Second, it assumes fast trade adjustment, whereas Malaysia's 2024 recovery proved that trade contracts are locked in for months, keeping trade volumes stable, while short-term currency movement were driven entirely by financial market sentiment. Third, it ignores the role of money supply and demand, missing how Bank Negara Malaysia's decision to maintain the OPR steady at 3% throughout the 2024 to 2025 supported ringgit stability independently of fluctuating global commodity export prices like palm oil. Fourth, it fails to account for asset wealth and risk preferences, unable to explain why restrictive U.S. Federal Reserve interest rates in 2024 caused capital to rebalance away from emerging markets into U.S. Treasuries, pressuring the ringgit despite Malaysia maintaining healthy trade surplus. Under the monetary approach, a strong 5.5% GDP expansion in 2025 directly increases the volume of domestic transactions, causing real money demand to rise because individuals and businesses require larger cash balance. Assuming Bank Negara Malaysia keeps the domestic money supply tightly managed, this creates a monetary shortage that forces the private sector to draw in capital from abroad, turning the balance of payments into a surplus to pull in foreign reserves. Simultaneously, the portfolio balance approach states that this robust economic growth signals high corporate earnings and strong industrial yields, prompting global investors to alter their risk-return profiles and rebalance their portfolios by aggressively purchasing Malaysian equities and corporate bonds, which triggers massive net capital inflows. Both approaches fundamentally agree on the final direction, predicting an appreciation of the Malaysian ringgit. However, because the U.S. federal fund rate sits much higher at 4.5% compared to BNM's OPR at 3%, the portfolio approach notes a nuance. This negative interest rate differential dampens short-term bond inflows, meaning the ringgit's appreciation is heavily driven by growth-oriented equity investments and foreign direct investment rather than sovereign debt plays. A risk of environment refers to a global condition where macroeconomic uncertainty or geopolitical tension cause investors to lose their appetite for risk, leading to a flight to safety where capital rapidly exits higher-yielding emerging markets like Malaysia for ultra-safe assets like U.S. Treasuries. According to the portfolio balance approach, this global risk spike alters investor risk premium perceptions, causing foreign assets managers to aggressively reduce exposures and contract their demand for both Malaysian bond and local Malaysian ringgit deposit. This triggers a net capital outflow as funds liquidate their Malaysian holdings, and the widespread selling of Malaysian ringgits to buy USD creates a massive supply of ringgit in the forex market, causing the currency to depreciate. To defend the ringgit, Bank Negara Malaysia can raise the overnight policy rate, an action directly supported by the portfolio balance approach because the higher yields narrow the negative interest rate gap with the US, compensating investors for risk and enticing them to keep the local capital. The monetary approach fully agrees on this stabilizing outcome but views it through a different lens. Raising the OPR increased borrowing costs, slows down the credit creation, and shrinks the domestic money supply relative to money demand, which creates an internal ringgit shortage that forces the currency value upward and reserves the BOP deficit. Multinational corporations face three distinct categories of currency risk that can affect their operations and financial health. First, transactions exposure is the risk that the currency value of known contractual cash flows, with change due to unexpected exchange rate fluctuation before transaction settles, such as a Malaysian electronics manufacturer importing chips from Taiwan with a 1 million NTD invoice payable in 90 days, which becomes costlier if the Taiwan dollar appreciates against the ringgit. Second, translation exposure is the accounting risk where the foreign currency denominated financial statements of subsidiaries must be consolidated into a parent company home currency at current exchange rate, illustrated by Axiata Group or Maybank translating the assets and liabilities of their Indonesian or Pakistani units into RM for their annual reports, where heavy foreign depreciation reduces global asset values on paper. Third, economic exposure is the long-term risk to a firm's future cash flows and overall market competitiveness caused by unexpected permanent shift in exchange rates, exemplified by Malaysia Airlines, whose long-term operating costs and competitiveness are structurally altered because jet fuel and aircraft leases are globally priced in USD, making a permanently weak ringgit highly damaging. To calculate the annualized forward premium or discount on the US dollar, we take the 3 months forward rate of 4.44 minus the current spot rate of 4.5 divided by the spot rate of 4.5 and multiply the result by 12 over the 3 months and multiply by 100. This formula gives an annualized forward discount of 5.33% for the USD. Interpreting this negative result, the USD is cheaper in the forward market than in the spot market, which explicitly implies that the market expects the Malaysian ringgit to appreciate against the USD over the next 3 months. Moving from 4.5 down to 4.4, this indicates that traders are willing to lock in a lower exchange rate for future delivery, signaling strong investors' confidence and expected positive economic shifts in Malaysia relative to the United States. For a Malaysian palm oil exporter due to receive USD 600,000 in 6 months, entering a forward contract to sell USD at a fixed rate of 4.22 per USD guarantees a forward revenue of exactly 2.532 million ringgits. If the exporter had chosen not to hedge, they would have been forced to sell their inbound funds at the actual open market spot rate of 4.1 per USD, resulting in an unhedged revenue of 2.46 million ringgits Malaysian. Comparing these two paths, subtracting the unhedged outcome from the forward revenue shows that the exporter achieved a net financial gain of 72,000 ringgits by hedging. This decision was completely justified for two key reasons. First, it completely eliminated downside risk by protecting the exporter from the severe market drop down to 4.1. And second, it provided crucial cash flow certainty, allowing the company to ensure predictable revenues to budget accurately for payroll, operations, and logistics without being exposed to erratic market volatility. To test if covered interest parity holds, we substitute the given values into the standard CIP formula, comparing the domestic return of 1 plus the Malaysian interest rate against the covered foreign return of 1 plus the US interest rate. Multiplied by the forward to spot ratio, this yields a domestic return of 1.05 and a covered foreign returns of 1.0094. Since these values do not match, covered interest parity fails to hold. Because the domestic Malaysian return is higher than the covered foreign return, a risk-free profit opportunity exists with covered interest arbitrage. where an investor can borrow USD, convert it to ringgit at the spot rate of 4.5. Invest the funds locally of Malaysia 5% rate, and simultaneously enter 1-year forward contract to sell the ringgit back at 4.41. This sequence allows the investor to repay the USD loan with interest and lock in a risk-free profit of approximately 0.92 USD per 100 ringgit invested. As arbitrages continuously exploit this imbalance, market forces will restore equilibrium. Heavy buying of ringgit in the spot market causes it to appreciate, while selling ringgit in the forward market causes it to depreciate, concurrently pushing Malaysian interest rates down to capital inflows and pulling US interest rates up due to borrowing pressures until both sides balance. Using the uncovered interest parity formula, we calculate the expected spot exchange rate 1 year from now by multiplying the current spot rate of 4.5 by the ratio of the domestic interest rate to the foreign interest rate, which results in an expected spot rate of approximately RM 4.5874 per USD. If a Malaysian investor places 100,000 ringgits locally in Malaysia at the 5% rate, the expected return at maturity is exactly 105,000 ringgits. Alternatively, if the investor elects to convert the fund to USD at the spot rate, grow them at the 3% US interest rate, and convert them back to ringgit at the expected future spot rate of 4.5874, the final return is also exactly 105,000 ringgits. Comparing the two investment tracks reveals that both yield identical expected returns, which tells us that UIP assumes investors are completely risk neutral and require no risk premium for holding unhedged assets. It proves that any nominal interest rate advantage, such as Malaysia's extra 2%, is expected to be perfectly offset by corresponding currency depreciation as the ringgit weakens from 4.5 to 4.584, equalizing expected return across countries. When foreign investors decide to increase their investment in Malaysia due to an improvement in the nation's sovereign credit ratings and stronger than expected GDP growth, it directly impacts the loanable funds framework. This massive influx of foreign financial capital increases the total pool of saving availability in the country, shifting the supply of loanable funds curve to the right. Because there is now an abundance of funds available for lending relative to local borrowing demand, the price of borrowing drops, causing the equilibrium Malaysia interest rate to decrease. Looking at the full adjustment process in the forex market, international investors must first purchase ringgit by selling their own foreign currencies to facilitate these capital injections, and this initial surge in demand causes the RM exchange rate to sharply appreciate. Over time, as domestic interest rate decline due to the capital influx, the asset yield advantage begins to diminish and stabilizes the rapid appreciation, leaving the final macroeconomic position with a lower domestic interest rate coupled with the stronger appreciated Malaysian ringgit relative to the initial baseline. According to the Fisher equation, the nominal interest rate is approximately equal to the sum of the real interest rate and expected inflation, meaning the real interest rate is calculated by subtracting expected inflation from the nominal rate. Applying this, Malaysia's real interest rate is 5.0% minus 1.5%, which equals 3.5%, while the United Kingdom real interest rate is 4.0% minus 2.5%, which equals 1.5%. Based on these figures, real interest parity predict that capital will naturally flow from countries with lower real interest rates to countries with higher real interest rates in search of superior inflation adjusted returns, meaning capital will flow from the UK into Malaysia. If capital is allowed to flow completely freely between both nations, this massive movement of funds will eventually eliminate the gap. The heavy influx into Malaysia will expand the supply of loanable funds and drive down Malaysia's nominal interest rate, while the capital flight from the UK will shrink its fund supply, pushing the UK's nominal interest rate up until real interest rates equalize across both nations. The J-curve effect outlines how the country's trade balance initially worsens, immediately following currency depreciation, before eventually recovering and moving into substantial surplus, tracing a path that resembles the letter J. In Phase 1, which represent the immediate short run of days to weeks, fixed contracts keep import and export volumes flat, but the RM price of imports immediately rises, causing the trade balance to instantly worsen. In Phase 2, spanning month 1 to 6, the trade balance hits its deepest deficit through because trade remains highly short-run inelastic. Buyers are locked into contractual obligations and need time to find domestic alternatives, keeping import bills high while export volumes fail to expand. In Phase 3, covering months 6 to 12, a transition turning point occurs as consumers cut back on expensive foreign items and foreign buyers respond to cheaper RM prices, causing import volumes to drop and export volumes to expand. Finally, Phase 4 delivers a significant plus after 1 year and beyond, as structural volume adjustments fully mature with significantly lower import volumes and expanded export revenues. This perfectly mirrors Malaysia's 2023 to 2025 experience, where the ringgit's initial depreciation heavily inflated intermediate import bills and squeezed trade margins. But by late 2024 and 2025, long-run structural adjustment kick in as manufacturing and electronics exports surge due to competitive pricing, completing the upward swing of the curve. The Marshall-Lerner condition states that for currency depreciation to successfully improve the trade balance in the long run, the sum of the absolute price elasticity of demand for export and import must be greater than 1, summing the given export demand elasticity of 0.4 and the import demand elasticity of 0.3 yields 0.7. Since 0.7 is less than 1, the Marshall-Lerner condition is explicitly not satisfied. Looking at the specific volume adjustment using the elasticity formula, a 10% depreciation of the RM causes export volume to increase by 4%, as Malaysian goods become cheaper for foreigners, while import volume decreases by 3%, as foreign goods become more expensive for local consumers. Ultimately, because the Marshall-Lerner condition is not met, the final trade balance will worsen. This occurs because demand is highly inelastic, meaning consumers and businesses in both nations are structurally unresponsive to price adjustment, allowing the 10% price spikes on import to heavily outweigh the minor 3% drop in import quantity, while the small 4% expansion in export volume fails to offset the overall loss in value per unit terms, dragging the net balance further into deficit. That's all, thank you.